In this video, I'm going to share with you what capital allowances are, how important they are, and some of the things you ought to know about so you don't miss out on capital allowances. This will significantly reduce your tax legally within the rules set by the government. Capital allowances are one of my favorite tax reliefs. So when you spend money on capital equipment, plant machinery, etc., you can claim capital allowances and reduce and possibly even eliminate your tax. So you might be thinking, what are capital allowances? So to make the example really simple and easy, I will look around this particular room and share with you 3 or 4 things that stick out on which you can claim capital allowances. But to keep it really simple, it's basically anything that's fixed to a building. That's keeping it really simple. It's more longer and complicated than that, but just to keep it simple for property investors. So here we've got central heating and radiators, capital allowances, aircon unit, capital allowances, suspended ceiling, capital allowances, lighting system, capital allowances, smoke alarms and smoke detectors, capital allowances, camera system, capital allowances. All of these things and many more things all qualify for capital allowances. So what happens is, at the end of the year, your accountant or whoever you use prepares your accounts and says this is your profit. They then prepare a tax return, and on that tax return they can claim certain reliefs. Capital allowances is one of those reliefs that they use to write off your taxable profits. And depending on how much you've got to claim, like I said, you could eliminate all of your tax for that particular year. If you don't use the capital allowances in the given year, you get to carry them forward and then you write them off on a writing down allowance basis. So the big one is plant and machinery. So this is plant and machinery that you buy for your property business or for your business generally. And how it works is you can accelerate your capital allowances by using something called an annual investment allowance. This allows you to write off up to £200,000 worth of expenditure in that year in one go. So to give you an example, let's say you've got £150,000 worth of profit in a year and you've spent £250,000 on plant and machinery. So in that year, from the £250,000 of plant and machinery, you could use £150,000 in that year and write off all your profit. Or you could choose to use £100,000, therefore having £50,000 figure left over for tax purposes. So if you accelerate those allowances, you're using your annual investment allowance. Alternatively, if everything goes in your general pool, and without meaning to make this too complicated, if it goes into your general pool, you can claim up to 18% in any one year. So if you only wanted to claim 18% of the 250 grand, you could do that, but your accountant will say to you, maybe use up all the allowances to write off the tax, because that would make sense. Why would you want to pay tax when you can avoid paying tax in that particular year by using your capital allowances? Or if you had no profit in that year, but you've got 250 grand spent, you can just carry forward your allowances to the next year and then write them off at 18%. What the government has done up until January 2022 is you can accelerate up to £1 million in expenditure using capital allowances, and after that date it will then go back to the £200,000. So the business is the government is incentivizing business to invest money in plant machinery and to grow their businesses, and therefore it's given an advantage or a benefit to say if you spend money up to £1 million, you can write it up all in one year. So it really helps reduce your tax in a big way. Now, if you've got a limited company, you reduce the corporation tax. So if you made £100,000 profit, you'd be paying 19% tax on that. If you claim capital allowances, you write off the capital allowances against the profit. So let's say you write off £50,000 against capital allowances, you've got 50 grand profit left, you pay 19% corporation tax on that figure. If you want to then take that money out for personal use, you'd obviously pay income tax based on your personal rate of tax, and that depends on how much money you've taken out in that particular year. To move that scenario over to a sole trader, partnership or an LLP, if you've made £100,000 profit and you've written off £50,000 worth of capital allowances, you would only pay income tax on the balance of the figure, which is 50 grand. So that would mean you pay less income tax. If you write off 100 grand in capital allowances against the 100 grand profit, in that particular year you pay no income tax. So the difference is, in a company you reduce the corporation tax liability, but when you take the money out you still have to pay income tax. If you're an unincorporated business, you write off the capital allowances, there's no tax to pay, you can take all that money out for personal use, you still don't have to pay any tax. So there's an advantage there which you ought to be thinking about, is should you structure some of your business to use an LLP, sole trader or partnership, if you're going to be claiming a large amount of capital allowances for a number of years. You cannot claim the annual investment allowance for cars, but you can still claim capital allowances for cars which the business owns. So that's quite helpful. There are the benefits obviously of having cars, but being able to claim capital allowances is one of them, so that's really cool too. So if you own residential property, you can't claim capital allowances. If you own an HMO, you can claim capital allowances for the common areas. If you have a serviced accommodation business, then you can claim capital allowances for all the expenditure which qualifies for capital allowances, as long as your business is treated as a serviced accommodation business, and there are certain rules you have to meet for that. While I'm here, I'll share with you as well, if you have a serviced accommodation business, Section 24 finance costs don't affect you either. So there is good mileage in you thinking about using some of your property to run as serviced accommodation. If you're buying commercial property through a pension, so let's say a SSAS, a small self-administered scheme, then remember you can't claim capital allowances because a SSAS doesn't pay tax, so there's nothing to write off. So you want to make sure you do your calculations to see if it's worth buying through your pension or not. The other big one really is, when you're buying commercial property, make sure you do all the correct inquiries through your solicitor, because there may be capital allowances to claim on the purchase. And you have to do that properly, because if you don't, then you may lose your ability to claim some of the capital allowances. And if that happens, by the way, you may still be able to claim integral features. So again, don't want to get too complicated, just want to raise your awareness so you know what's available. But speak to an accountant or a tax advisor, or speak to me, happy to talk you through that. We do lots of capital allowances claims for people, so we'll help you with that. So on a purchase, there's a possibility you claim capital allowances. You then buy the building, you carry out the refurb, you then get a second lot of capital allowances, so you can end up with 2 lots of capital allowances, which adds up to a considerable amount to write off your profit in the future years. So it's a really good tax benefit that you ought to know about, and make sure you claim it both on purchase if it's available and ongoing for all your capital expenditure. Alongside that, you've got the structures and buildings allowance, which is 3% per year, which is available to commercial property and not residential property. So make sure you consider that too if you're into commercial property investment, because again, although it's a much smaller figure, it adds up over the years. When you're selling the asset, you may have a balancing allowance or a balancing charge, depending on how much you've claimed in terms of capital allowances. So if you've accelerated the allowances using the annual investment allowance, the chances are you might have to pay a balancing charge, because you claimed more of the allowances quicker and the value of the assets was higher when you sold it. So there's a tax charge there. If you sell it for less than what it's worth, then you'll have a balancing allowance. Again, don't want to complicate it for you. Just want you to be aware, when you're selling an asset, there could be a balancing allowance or a balancing charge, and that's something that you ought to know about. So in summary, capital allowances are fantastic. They make a huge difference, especially if you're buying commercial property, especially if you're running serviced accommodation. So look into those and make sure you don't miss out on this allowance, because it really can be a game changer, especially if you're scaling up in a big way.